You're listening to Advice Amplified, and this episode's guest is Mark Stringer.
There's a big segment of this marketplace that's just underserved.
The owner and founder of Harati Consulting, co-founder at B2 Capital, an all-round legend of the financial advice landscape.
I found it staggering that software was an unregulated industry.
We talk about the impact of macroeconomic changes, the rise of private equity, and the increasing role that technology and AI has in shaping investment decisions and financial advice practices.
Well, one could argue it was a very pleasant walled garden that this advice industry had created for itself.
I hope you love this episode. Please do subscribe to the podcast and check us out on TikTok, Instagram, and YouTube at Advice Amplified. Thanks so much for coming on to Advice Amplified. I'm really pumped for this conversation. I think it's going to be a good one.
Very excited about it, Pete. Keen to be part of the great collective that you've assembled for these podcasts. So very happy to get stuck into it. And what a subject.
What are some of the things you're kind of seeing or hearing from, I guess, private equity or some of the platform or product manufacturers, specifically as it applies to this kind of market?
We look at the pricing of assets, asset manufacturing, and how asset manufacturers are getting these products into people's savings propositions and pensions. This market, I think it continues to defy certain norms. We have had many generations of the defined benefits and DC schemes and money purchase schemes. We've seen that serve a lot of generations. The next wave of generations coming through to this are doing a lot of self-service and finding out for themselves. And we have an inflection point, I think, where the traditional advice mode won't be relevant to a lot of these new entrants. And I think it's an area that we will again discuss today. Will be what one could describe as white space that providers such as Ningi, much more nimble, tech-centric and data-centric players are able to serve and start to address the needs of this next generation of investors who will be certainly looking and doing a lot of browsing to understand where they should actually deploy their savings. So I think it's a great inflection point within I guess the next cycle of savings. And we also have this vast amount of wealth that will be moving through the generations in this country. It's several trillions over the next 10 to 15 years. The States, it's north of $40 trillion is moving from the boomers. And from latest stats that we've got, only 12 to 13% of inheritees, if you will, in the US are going to use the same advice model or provision model that their parents were using.
Because you've almost got like a convergence, haven't you, where accessibility to financial products is just ramping up. They're really low cost, available online. There's lots of support and information around buying them, but also I guess transparency and access to information. So all of those things clustering together, I guess, is creating like a wave of opportunity or challenge for financial advisors that maybe have been custodians of information and the gatekeepers in the past.
I'd agree. One could argue it was a very pleasant walled garden that this advice industry had created for itself. But yes, with the onset of the type of power and information access that one's got in one's hand today, with whether it's your iPhone or whatever, this is starting to open a window up on what is possible in regards to saving and long-term financial planning. Probably accelerated over the last 2 or 3 years as a product of the pandemic, of the various stimulus packages that certain central banks and administrations use to get money out to people that were not planning to spend that money. And we have seen a boom in the use of let's say online trading platforms. I think only recently Robinhood just appointed the CEO for the UK. So whilst they parked their plans to enter the market a few years ago, I think that's now back on. So it's going to be services like this that start to broach the whole arena of financial education for the Gen X's and Gen Y's and millennials that are looking at what they're doing with long-term savings and how they're actually, some of them, having to plan their families' financial plans, and that will include the long-term healthcare and long-term provision for their parents, ergo the early boomers.
Because it's almost like two C's that are meeting there. There's the self-directed, do-it-yourself, making that more accessible, and then you've got the financial advisors will help you and kind of coach you through the process. Is it almost a case that one's replacing the other, or will there always be a natural interplay? So I suppose I'm wondering, is the world looking on at financial advisors and sort of saying, look, this is happening, you need to reinvent yourselves, increasingly be relevant and move forward? Or is that always a thing that's just going to swell together?
There's a big segment of this marketplace that's just underserved. And we look at, again, some of the statistics that you need to drill down to. Just under half of advisors in the UK haven't got succession plans. So this is worrying for their customers. It should be worrying for the employees in the advice companies as well. So that is one stat to look at. The ones that have got succession plans, there's often a case that their offspring are coming into the businesses. And this actually is, some evidence of some forward thinking, where you've got the next generation of advisor that have come into a business that was set up and operated by one of their parents or both their parents. And they've got an appeal to the generation that we were talking about a few moments ago, who aren't thinking about using an advisor. But I think that's relatively niche just now. There probably is a bit of a perfect storm coming up, where you've got the provision of more financial information and education that's at people's fingertips without an advisor. You've got this next gen of advisor that will try to appeal on a more mass market footing with the power of technology. And we'll talk, I guess, a bit later on about the role of AI, but how these support or tertiary services can be harnessed by the next generation of advisor to access a wider client base, and a client base that we all believe is there and ripe for the picking, and also there to be helped. And then back to your first question, looking up and down all around the manufacturing end of the value chain, you've still got mass market providers and manufacturers that are more than happy to put their services to work within this marketplace. If you read recently, I think BlackRock have launched an active, I think, ETF at 8 basis points. You want to be looking at a service and an advisor who is pointing you at these incredibly powerful products, probably just benefiting from compounding and having that as part of their financial plan. But it's not the be all and end all. It's an element of a longer term financial plan. So I think we're looking at continued white space in the entire advice arena, and I think it will be I could call Ningi a startup, or the upstarts such as yourselves, but organizations that believe that one can start to take these types of services to the next generation of consumer. I think we're going to see it playing out over the next 5 to 10 years. And I think we'll see a prevalence and an arrival of new and fresh service models that are arriving much faster than we've seen historically.
Well, one thing that struck me in what you said with financial advisors engaging with almost the next cohort, the children of their clients. I mean, presumably, if you're not doing that, the value of your firm and the viability of your firm going forward is going to be pretty dramatically impacted.
I couldn't agree more. I think we're seeing a polarization in the organizations that are organized and prepped, maybe using the cliche of the folks that were able to fix the roof while the sun was shining. In the last few years, we've now seen the access to cheaper capital has disappeared. So organizations that realized they hadn't deployed sufficient capital in rejuvenating their models and making their models modernized are now struggling. I mean, that also pitted with valuations are probably on a downward trend for some of these organizations. So are founders going to stick around for a few more years as opposed to exit and take a discount on what they were hoping to achieve? I think there is going to be quite a polarization. That will be opportunistic for the acquirers, the acquisitive folks, the people that have got dry powder and are ready to deploy more capital into this marketplace. And we're seeing news every week. I don't see that abating. And there are, I think, a great number of firms that are now just hunkering down for what will be 5 to 10 years of growth and acquiring the next generation of customer. There are certainly organizations that we could evidence where the founders or principals just now are, they're pretty frightened because they're predicting, the longevity of their customer base, and they're thinking, I need to get out of this business pretty soon because it looks like over half of my customer base aren't going to be here in about 10 years' time.
I mean, the observation I've got, and I know you've made this yourself, that the advisory model being a platform in and of itself, we've seen this with technology where, go back 20 years to start Google, they literally were building servers in a garage, and they were fundamentally like plugging stuff in, and then that gets packaged up, and you've got cloud and platform as a service and those kind of things. And now you've got back end as a service, and I guess advisory models as a service is now kind of a term we're seeing.
I couldn't agree more. My background, a software engineer, but not writing code. I haven't written code for a long time, but I've watched the arrival of cloud-based services that are hyperscaling, where you can access almost infinite compute power. So the idea of assembling your own platform and indeed accessing some advanced discretionary services, the ability to assemble all of this under one roof, I think this is something that we'll almost certainly we're going to see, and we can also witness the providers that are in the marketplace that have tapped into this theme. Whether you want to call it Moore's law, but it still appears to be applicable to how one can go about assembling these services. It probably does lean to the progress of specialization as well. Highly specialized firms, specialist in managing and harnessing all of that tech, but specialist in delivering relevant and up-to-date and durable financial services and financial products is critical, and probably a much fuller service model where you're thinking about estate planning, you're thinking about tax planning, you're thinking about optimizing any spare money that families or individuals may have.
A small team can now build a financial advice business, get regulated, run everything from the proposition to potentially a platform without having to have a huge infrastructure, huge team, huge overhead. I think that's going to be really exciting.
With the right skills, in the right hands, the guardrails are effectively there from these providers sitting on the cloud. You're going to get delivery and service certainty from these organizations. They're not going to get hacked or have a data breach. Otherwise, their stock price is going to tank. Trying to in-house some of that stuff, well, that's extremely difficult. The barriers to entry they're as high and probably getting higher than they've ever been. The focus has to be on the regulator and how the regulator is encouraging and harnessing these types of disruptors, if you will, inviting them into their sandbox, understanding how, for example, AI is going to be applicable and how is AI going to be deployed within the right hands. As you know, I have a heritage at Microsoft, and when I was writing software, I found it staggering that software was an unregulated industry. I guess the closest regulation has arrived within the software universe is data protection, and indeed, and a number of the cybersecurity regulations. But to this day, regulation around actually building a code stack isn't there. So there is a huge amount of responsibility has been placed on people that are now using this stuff. And we've got the we need to look to the regulator and the Information Commissioner's Office to ensure that these guardrails are there so that we don't have barriers to preventing these disruptors arriving in the marketplace and delivering these services. It hopefully should be accelerated with the arrival of the next gen of advisor, and indeed customers that will expect so much more delivered to their palm 24/7 and on demand. You talked about some of the innovators that came out of the valley in the last 20 years, but as Zuckerberg often said, the servers just can't break. If someone comes online and the service isn't there, they will move somewhere else, and it's almost a split-second decision. And this is something that we need to be savvy to within this marketplace.
Totally. Digging back to your point on regulation, this is something I've been kind of rolling around my brain, I suppose, a little bit, because at the moment you've got a situation where like the key kind of chunks of delivery of financial advice businesses themselves, they're regulated, they're subject to crazy PI insurance and all this kind of stuff, and then the platforms are regulated. Increasingly, that bit in the middle that's doing CRM, but then all of a sudden automating workflows, generating documents, doing calculations, maybe cash flow modeling, that's increasingly kind of fundamental to giving it. There's no regulation there that, and I wonder, should there be? Or, I mean, I've probably got a personal bias towards the longer there isn't, the better, but, maybe it makes sense.
I think that's a great question. And preparing for this session with the Ningi team today, I was thinking about this. What's causing this polarization within the service providers that we believe will survive and the ones that are struggling is the onset of consumer duty. It's caused a whole range of providers to look at their operating models and cost bases. The ones that were prepared were able to make changes to their op models because they'd harnessed the power of tech and data. Are looking at this opportunistically. The ones that didn't are now struggling, and we realize what that's happening. And we can see that news and events every week with organizations that are struggling with that legislation and that regulation. There'll almost certainly be an opportunity as we get large language models being deployed and generative AI and properly harnessed, where one can start to train these services to ingest this regulation. Or indeed, if the FCA wishes to expose it as a beta level within the sandbox, and they bring what they deem as qualified operators, people that have proven to everyone that they've actually harnessed AI properly, and they've actually set their own guardrails down, come into the sandbox and test this regulation for us. Because the only way we're going to attack the underserved and the excluded from financial advice is by almost turbocharging what the advisor and the paraplanner is able to do. So you can effectively scale up their capability with the digital assistants that they have got with them. But these are digital assistants that have been augmented over regulatory frameworks that have been proven and stress tested.
Yeah, there's a lot of fear and potential risk of using some of these LLMs, or the amount of people that are turning to ChatGPT as their financial advisor, being able to wrap some control, wrap some, I suppose, context and feed it the regulatory rule book, I say, so to speak. That's a really interesting concept.
Look, 100%, and we shouldn't be fearful. We know how folks were fearful of automation and mechanization at the beginning of the Industrial Revolution. So this is just the next industrial revolution. Inevitably, we are going to see a lot more productivity presented to providers and actors within the marketplace. I hear stats, and I often quote stats from, for example, Daniela Rus at MIT CSAIL, where she runs the artificial intelligence lab at MIT. And she talks about 50 to 60% of the firms in the Fortune 500 over the next 5 to 10 years don't exist yet. And this is also linked with the future of work operation that's running at MIT as well. So if you start to peer into what the futurists and folks such as these are describing about the future of work, it brings huge opportunity. And we've already discussed this white space today, and the fact that there are probably 12 to 13 million people in the UK that aren't getting any form of a meaningful financial advice and long-term savings help. And my word, if you could actually multiply yourself, Pete, and your colleagues 100-fold, and deploy that with people who come up for air or come up for questions from time to time with an actual human, what's the problem with that?
There is so much white space and so much, literal advice gap. There's people, I think it was something like 6.5 million people last year or the year before actively seeking advice and were turned away or couldn't find it for probably pricing or inefficiency or those kind of things. I suppose I'm undecided on whether AI or business model, are we in a hype curve? Is this just a kind of, everyone's really excited, ChatGPT came out, there was this big kind of overhang in what was possible, and so everyone thinks the world's going to end? Or is it actually going to move that quickly? And, in 5 years, are we going to just see all of these firms that couldn't have been predicted in 2023, all of a sudden 2028, they just came from nowhere and took over the world?
It's interesting, Pete. I was listening to Scott Galloway recently, and he was coining that he felt that taking the Gartner hype cycle, we've probably reached peak AI at the moment. So what comes next is a trough of disillusionment, and then we have to look forward to the slope of enlightenment. So yes, I think some of the heat's going to come out of the marketplace. Anyone jumping into OpenAI or Anthropic or whatever at the moment, probably going with a cautionary note, because valuations will probably drop off. But this happens with tech. One needs to have a medium to long term view, and understand what does that slope of enlightenment look like. The smart operators would have priced this in and also thought through what their roadmaps are like for the next 3 or 4 years. We'll be through that trough of disillusionment over the next 2 or 3 years, but again, we're talking and looking at this narrowly through the wealth or asset management industry. But if you look in the US at how health tech is getting modernized and health advice is being supplied to consumers alongside the existing and traditional health services, it's an area of incredible VC interest in the States, and we're seeing many funds looking at this marketplace. That's just one area. If you move into the realms of renewables and the next generation of smart energy consumption, again you can see a similar degree of hype. So I think look, we get peaks and hype in these markets in particular, but I think the next 3 or 4 years we'll start to see stabilization and real world, highly beneficial use cases coming from AI.
We definitely observed and sat back and watched some of these startups come to market. Probably in the first half of 2023 that were really just light wraps on top of OpenAI that raised a bit of cash, seemed really exciting, moved really quickly, but there was no fundamental kind of value to the proposition that can just be swallowed up, by Bard or whatever else it might be, or Copilot. I suppose what you're saying is actually over the next couple of years, if there is utility and value in there, there's utility and value in there, and there will be change from it. And it's,
You mentioned it a few moments ago, Pete, but the idea of infinite compute power at marginal cost is a huge opportunity, because one can now set LLMs to work on ingesting vast quantities of data. So if that data is being harnessed to improve investment outcomes, remove the data asymmetries that sit within marketplaces, and start to smooth curves in investment performance, that's got to be beneficial. And it's all about trying to drive alpha. And we've got numerous use cases in the research that we do of organizations that are doing this, and the next generation of applications, which will just start to operate in what you could say are those 2 to 3 degrees of separation, where just providing market tracking performance on the indexes against alpha. So these folks are really pushing the boundaries, which is a positive thing.
with everything you're kind of seeing from a technology perspective, but also just some of those bigger kind of macro moves in the market and in the industry, what are you most optimistic about, and where do you kind of see things moving towards?
I think we are at a potential crossroads, or we'll call it an inflection point over the next few years, where the advice industry and the whole notion of financial advice is going to have a degree of responsibility like it hasn't had since its real inception, I guess, as we would describe it, over the last 30 to 50 years. And this is primarily because of the movement of a vast amount of wealth between generations. The first time that a number of members of a family or generations will have to be compelled to seek some financial advice. So it's a huge responsibility on the industry to ensure that it's doing the maximum it can, together with administrations, central governments, and regulators, to ensure that type of advice and guidance is made possible and accessible to all takers. And then I would also caution that with this type of upswell in, let's say, inherited wealth, for example, we are moderating this industry for the bad actors. The notion of trust, reliability, and security are absolutely paramount, because unfortunately, with these events, you will attract folks with nefarious objectives, and that monitoring is again down to the actors and the operators within the industry. So, huge responsibility, huge opportunity. And again, a country where actually there is a framework, a very strong legal frame and a regulatory framework, where this can probably be executed responsibly and in a model that could be an exemplar to other countries.
That's a fascinating answer, Mark, and we really enjoyed the conversation, and I think it's exciting times, isn't it, really?
100%. I really enjoyed it, Pete, and it's great to be invited, and thanks for letting me share some of our opinions from our perspective.
Oh, thanks again, Mark. Thanks.
Pleasure.
Cheers.